Imagine you are the most successful person in the room. Every room. It's 1989 and you are Japan. Japan as number one. A Harvard professor called it in 1979. By 1989, it wasn't a provocative claim. It looked like a prophecy. The carry trade began unwinding. Over the following 3 weeks, $6.4 trillion was erased from global equity markets. The Tokyo Stock Exchange had its single worst day since the 1987 Black Monday crash. The Nikkei fell 13% in one session, from a 0.25% rate hike. Pay attention to this. Japan's interest rate policy is no longer just Japan's problem. The carry trade has made Japan's monetary policy a load-bearing pillar of global financial stability. Ice 4, the bond market cliff. Japan's government debt stands at 1.32 quadrillion yen. At near zero rates, debt servicing was manageable. The government could borrow indefinitely because borrowing cost effectively nothing. Now rates are rising. Even the move from 0 to 0.75% has pushed annual debt servicing above 31 trillion yen. A 10.8% increase in a single year. Market consensus is that rates eventually need to reach 1%, at which point debt service consumes roughly 20% of government revenues. At 2%, still historically very low. Debt service absorbs more than 1/3 of everything the Japanese government collects in taxes. And here is the cruelest detail. The Bank of Japan itself holds 10.5 trillion yen in unrealized bond losses. Raising rates makes the BOJ's own balance sheet bleed. You are not just winning. You are redefining what winning looks like. The machine is now running at full speed. Raising rates, fiscal catastrophe, carry trade unwind. Upping rates low, yen weakness, import inflation. The debt grows regardless. The demographics worsen every year. In the next section, we're going to look at the moment this trap went from a problem. Economists argue about to the Prime Minister of Japan publicly comparing his country to Greece. May 2025. Japanese Prime Minister Shigeru Ishiba stands before reporters and says something no. Sitting head of government of a G7 nation is supposed to say out loud, Japan's fiscal situation is worse than Greece. Greece, the country that needed 3 international bailouts between 2010 and 2018. A country whose debt crisis nearly broke the Eurozone. The comparison Ishiba chose was not accidental. He was trying to force a consensus for fiscal consolidation. Had been Prime Minister for less than 8 months. The bond markets quietly took note. A week later, the Japanese government held a routine auction of 40-year bonds. $6.9 billion in issuance. And something went wrong. Demand was the weakest since 2012. The tail, the gap between average and lowest accepted price, was the ugliest reading since 1987. Buyers were walking away from Japanese government debt. Routine buyers. Institutional buyers who had shown up reliably for decades. And then the music stops. This is not supposed to happen in Japan. SMBC Nikko Securities strategist Ataru Okumura noted that foreign investors had been the dominant source of demand for super-long Japanese bonds in the first half of 2025. When those foreign buyers pulled back, partly because Donald Trump's tariff war was disrupting global debt markets, The domestic bid was not strong enough to fill the gap. For the first time in living memory, the automatic stabilizer built into Japan's debt market was failing to stabilize. Japan's baby boom generation, the people who rebuilt post-war Japan, who saved diligently their entire working lives, was now moving past 75 years old. They were not accumulating savings anymore. They were drawing them down, collecting pensions, paying hospital bills. The greatest domestic savings pool in the history of any nation was beginning to drain. Japan's debt situation has always depended on one structural reality. Nearly all of its government debt is held domestically. Like Greece in 2010, which owed money to German banks and the ECB and the IMF. Creditors who could, and did, got it off. Japan owes money largely to itself. This is why economists who predicted a JGB collapse kept being wrong for 15 years. Japan could always find a buyer, because the buyer was always a Japanese institution with nowhere better to put the money. Not slowly, not with warning. On December 29, 1989, the last trading day of the year, the Nikkei 225 peaks at 38,915 points. But when the population ages past the savings phase and into the spending down phase, the equation fundamentally changes. The automatic pilot switches off. Japan's population is 123 million today. It peaked in 2008. It will reach 100 million within 25 years. The birth rate sits at 1.3. For 14 consecutive years, the number of Japanese nationals has fallen. In 2024, the annual decline was the largest ever recorded. By 2040, projections estimate a labor force shortfall of 11 million workers. The ratio of working-age taxpayers to retirees, 10 to 1 in 1950, 4 to 1 in 1990, roughly 2 to 1 today, approaches 1 to 1 within 2 decades. Try running a welfare state on that math. Take your time. Mild wait. Japan's pension system, the Government Pension Investment Fund, the GPIF, the single largest pension fund on the planet, with roughly 220 trillion yen in assets, is already showing the strain. The GPIF has spent the past decade quietly rebalancing away from domestic government bonds toward equities and foreign assets, because the returns on zero-yield JGBs cannot cover future pension obligations. Every yen the GPIF shifts away from GBs is one less yen of captive domestic demand for the bonds. The Ministry of Finance needs to keep selling, one pillar of the structure being removed at a time. Then it starts falling, and falling, and falling. Japan imports approximately 90% of its energy, nearly all of it priced in US dollars. When the yen weakens, the cost of every barrel of oil, every liquefied natural gas shipment, and every ton of coal rises for Japanese buyers. In 2022 and 2023, as the yen fell to 30-year lows against the dollar, household energy and food costs surged. The Japanese government introduced emergency energy subsidies, costing tens of billions of dollars. Small businesses, roughly 70% of private sector employment in Japan, began closing at elevated rates. The yen's weakness was quietly draining the purchasing power of the very population it was theoretically designed to protect. The Bank of Japan has been raising rates, carefully, glacially, from 0 to 0.1 in March 2024 to 0.25 in July 2024, to 0.5 in January 2025, 0.75 in early 2026. Hike telegraphed months in advance, grounded by reassurances, packaged as gradual normalization. The language was always calm. The markets were not always calm. The July 2024 hike triggered the carry trade unwind that erased $6.4 trillion from global markets in 3 weeks. The New York Federal Reserve conducted a rate check, contacting currency traders directly to ask about dollar-yen exchange rates, an action so unusual that financial journalists stopped what they were doing and took note. A rate check is the financial equivalent of the bar owner walking the floor personally before deciding whether to call last orders. By August 1992, it has lost 60% of its value. Every door leads to a different version of the same room. If Japan's bond market breaks, the crack will not stay inside Japan's borders. Let us bring this down to ground level. There are 123 million actual people living inside this machine. Meet Hiroshi. He is 52 years old. He works for a mid-size manufacturing company in Nagoya, the kind of precision parts supplier that feeds into Toyota's vast production network. He has worked at the same firm for 27 years. Earns the equivalent of around $50,000 a year, roughly the same real wage, adjusted for inflation, that he was earning 15 years ago. Japan's real wages have not meaningfully increased for 3 decades. Not a slowdown in growth, not modest progress, flat to negative for 30 years. The Shunto, Japan's annual spring wage negotiation, delivered headline raises of 5.6% in 2024, the largest in 33 years. Front page news. A turning point, the newspapers called it. Hiroshi's company offered 2.1%. Core inflation ran at 3%. I received a real wage cut, delivered in an envelope with a bow on it. His mortgage is repricing upward. His energy bill is up. His grocery bill is up. His parents will require long-term care within the decade. Care that Japan's system is structurally underfunded to provide at scale. Daughter, 22, has a university degree and a part-time retail job. She is one of the millions of freeters. Young adults trapped in insecure, low-wage work that the lost decade normalized and the economy never corrected. Japanese banks, sitting on mountains of loans backed by land that is now worth half what it was 2 years ago, begin quietly suffocating under the weight of loans that will never be repaid. His son, 19, looked at Tokyo housing costs and decided to stay in Nagoya. Hiroshi votes for the Liberal Democratic Party, not out of enthusiasm, because the alternative feels like chaos. This is the silent contract Japan's political system has offered its citizens for 3 decades. Not dynamism, not resolution, but the absence of visible crisis. Stability as a product. The illusion of normalcy as the central policy achievement. The LDP has governed Japan through every year of the lost decade, the lost 2 decades, what economists are now quietly calling the lost 3 decades. Its structural response to the debt crisis. Announce a fiscal consolidation target, miss it. Announce a revised target, raise the consumption tax at decade-long intervals, triggering a recession that justifies fresh stimulus, which requires more borrowing which grows the debt. And if there is a hall of fame for perfectly self-sustaining policy loops, Japan's consumption tax and stimulus cycle belongs in it alongside a small bronze plaque that reads, "They really tried." Now step back from Hiroshi and look at the macro picture, because this is where the consequences stop being Japan's domestic problem and become the world's problem. Japan is the world's fourth largest economy, the second largest bilateral trading partner of the United States in Asia. Japan holds approximately $1.1 trillion in American government bonds, the largest single foreign holder of U.S. treasuries anywhere on Earth. Not China, Japan. If Japanese financial institutions are forced to repatriate capital from their overseas holdings, the impact on U.S. Treasury yields would arrive in the market in real time. The word economists will later use for these banks is zombie, technically alive, functionally dead, not still open, still processing transactions, and still pretending. U.S. mortgage rates price off Treasury yields. The cost of American government borrowing would rise. The global bond market, which has operated for 30 years, on the assumption that there is always a Japanese institutional buyer in the background, would have to reprice that assumption, hotly, completely, immediately. And then there is the carry trade, the true global transmission mechanism of whatever happens in Japan. The outstanding volume of yen-denominated carry positions is genuinely unknown. The Bank for International Settlements estimates gross yen lending to non-bank borrowers at over $1 trillion. If you include derivative structures, leveraged instruments built on top of leveraged instruments, the realistic figure is almost certainly several times higher. No institution has a definitive number. The inability to measure the size of the carry trade is not a technical footnote. It is one of the most dangerous features of the current global financial system. We know what partial unwinding looks like. August 2024, a 0.25% rate hike, and the Nikkei fell 13% in a single session. The VIX spiked to levels only seen in 2008 and 2020. A 0.25% Tokyo rate hike triggered the same fear reading as the collapse of Lehman Brothers and the arrival of a pandemic. Governor Kazuo Ueda walked back his language on future hikes within days. Markets recovered. The knife went back on the table. It is still there. Japan's 40-year bond yields have already crossed 4%, a level not seen since 2007. Here's the open loop I want you to hold. That crash happened 35 years ago. At 263% debt to GDP, servicing at those yields is arithmetically incompatible with maintaining Japan's current levels of pension payments, healthcare, and defense spending simultaneously. Option 1. Raise rates to defend the yen. Carry trade unwinds, global markets sell off, Japanese bank balance sheets bleed, debt service explodes, fiscal crisis accelerates. Option 2. Hold rates low. Yen weakens further, import costs rise, savings drawdown accelerates. Bond auction demand weakens anyway, because the underlying trajectory is visibly unsustainable. Option 3. Print money to buy every bond the market does to want. Yen collapses, inflation surges. The 40-year fiction that JGBs are safe assets ends in the most public way possible. There is a fourth option. domestic debt restructuring, that Japanese finance ministry officials have reportedly described in private as politically equivalent to burning down the National Diet Building. Probably not that one either. This is the open loop from Section 1, fully resolved. This is why Japan cannot escape. Not for lack of intelligence, not for lack of institutional sophistication, but because every exit requires absorbing a level of pain that 35 consecutive years of political choices have made structurally impossible to absorb quickly. The debt is too large to grow out of at negative demographic growth rates, too large to inflate away without destroying the purchasing power of 36 million citizens on fixed incomes, too large to service at normal interest rates without fiscal collapse, too politically radioactive to restructure. The machine is not broken. The machine is working exactly as the accumulated decisions of 3.5 decades built it to work. Most countries that suffer a financial crisis of that magnitude are back on their feet within a decade. Japan never fully got back up. Japan did not fail spectacularly. Japan succeeded spectacularly at hiding failure, at keeping the lights on, at maintaining the surface appearance of stability, while structural problems compounded silently below the waterline. That is an extraordinary achievement. A 35-year magic trick performed by perhaps the most technically capable economic bureaucracy on earth. It is also the most dangerous kind of crisis, not the kind that announces itself with an obvious breaking point. The kind that arrives as a bond auction that goes slightly wrong on a Tuesday morning in May. A rate check from the Federal Reserve Bank of New York that makes headlines because nobody expected it. A prime minister standing at a podium comparing his country to Greece and being factually correct. In the room quite knows whether to start laughing or to quietly, calmly start moving their money somewhere. The math actually works. So where does this leave Japan? What would genuine recovery actually require? Recovery would require, simultaneously, sustained real GDP growth above 2%. Difficult when your working-age population shrinks by hundreds of thousands annually. You have just built the most efficient manufacturing machine in human history. Here in 2025, with a debt pile worth 263% of its entire economy, a population shrinking by 500,000 people every single year. A central bank so cornered it now owns 53% of Japan's entire government bond market. Japan is not recovering. Japan is waiting, hoping, running out of time. A fiscal surplus large enough to reduce the debt to GDP ratio, requiring either tax hikes large enough to trigger the recession that kills the surplus, or spending cuts severe enough to dismantle the welfare state. Japanese voters have consistently refused to surrender. Interest rate normalization, which risks triggering the very financial crisis that makes everything else impossible to manage simultaneously. And a demographic reversal no developed nation has achieved once the birth rate has fallen this far. Any one of these in isolation would be genuinely difficult. All four simultaneously is. The word in serious academic literature is unprecedented. This does not mean Japan collapses. Japan is not Greece. Its creditors are domestic. Its institutional resilience is real. The country rebuilt from rubble in 1945. What Japan is almost certainly facing is permanent managed decline. A slow-motion fiscal dominance. The Bank of Japan permanently subordinated to government debt management. Rates never fully normalizing. Real wages flat. Population shrinking. Rural economies hollowing out. There are already 8 million vacant homes across Japan, called Akia, with projections of 23 million by 2033. Wealthy, technically sophisticated nation. On permanent extraordinary fiscal life support, hiding the diagnosis behind impressive GDP numbers and world-class trains. Japan is not an outlier. Japan is a preview. The United States, the United Kingdom, most of continental Europe, South Korea, all aging populations, expanding debt, central banks that spent the post-2008 era suppressing rates and buying their own bonds. It's a machine, a self-reinforcing doom loop built from debt, demographics, the monetary policy so extreme it has warped Japan's entire financial system into something that no longer resembles a normal economy. Japan's trap was built one reasonable-seeming short-term decision at a time. Every rate cut that made sense given the conditions. Every stimulus package that prevented the recession, that would have forced adjustment. Every fiscal target missed with a thoroughly defensible explanation. The trap is not made of obviously bad decisions. It's made of good decisions. Decisions that prioritized the present over the future, stability over adjustment, the appearance of normalcy over what the math requires. Japan avoided a visible crisis by building an invisible one. A very large, very patient, very expensive invisible one. If this video gave you a clearer picture of something the mainstream headlines are not telling you, subscribe. Not as a generic ask, but because this channel exists for people who would rather understand what the balance sheet says than what the press conference says. Those are increasingly different things. The debt trap is real. The only question now is who figures that out first. The markets, the politicians, or the people quietly paying for it. To understand how Japan built its own trap, you have to go back further than 1989. You have to go back to a conference room in New York City in September 1985, and a document called the Plaza Accord. By the mid-1980s, the United States had a problem. Ronald Reagan's administration had cut taxes and ramped up military spending simultaneously. A combination that sounds fiscally insane because it is. The result was a massive U.S. trade deficit. America was buying far more from the world than it was selling. And the biggest single contributor to that deficit, Japan. Japanese cars, Japanese electronics, Japanese everything. Congress was furious. American manufacturers were losing jobs. The political pressure on Washington to do something about Japan was becoming impossible to ignore. So the US did what powerful countries do when they want to rewrite the rules. It called a meeting. September 22nd, 1985, the finance ministers and central bank governors of the 5 largest economies gathered at the Plaza Hotel in Manhattan. Your companies don't just compete. They humiliate the United States, Japan, West Germany, France, and the United Kingdom. The agreement they signed that afternoon would quietly detonate the Japanese economy 4 years later. The Plaza Accord was simple in structure. The 5 countries would cooperate to weaken the US dollar against the Japanese yen and the German Deutschmark. The goal was to make American exports cheaper and Japanese imports more expensive, closing the trade gap. What worked spectacularly, almost immediately. Within 2 years, the yen had appreciated by 50% against the dollar. Japanese exporters, the Toyota factories, the Sony assembly lines, the Hitachi plants, suddenly found their products had become dramatically more expensive for American buyers overnight. Tokyo panicked. The Bank of Japan, led at the time by Governor Satoshi Sumita, responded the way central banks always respond to an economic slowdown. It cut interest rates aggressively. The official discount rate fell from 5% in 1985 to a historic low of 2.5% by 1987. And then it stayed there, month after month, for 2 full years, while the Japanese economy, as it turned out, was actually accelerating. GDP growth in 1987 and 1988 was running above 4% annually. The emergency was over. The emergency rates stayed anyway. Sony, Toyota, Mitsubishi, names that make American boardrooms sweat through their suits. And this is where the machine begins to build itself. Like money flooded the Japanese financial system at exactly the wrong moment. Japanese banks, operating under a Ministry of Finance system called window guidance, essentially. The government quietly telling banks how much to lend and to whom, dramatically expanded their loan books. Total bank lending grew at double-digit rates every year from 1986 through 1989. An increasing share of that lending was collateralized against real estate. Japanese regulations allowed banks to count unrealized gains on their stock portfolios as part of their capital. And so as stock prices rose, banks could lend more. As they lent more, asset prices rose further. As asset prices rose, banks could lend more again. You see where this goes. Japanese corporations discovered something called Zyatech, financial engineering, where instead of investing in factories and research, companies began borrowing cheaply and speculating in stocks and real estate. Firms like Toyota and Nippon Steel were generating more profit from financial speculation than from their actual products. This was considered innovative, but sophisticated, a sign of Japan's economic maturity. It was, in reality, a sign that the machine was running out of legitimate things to do with all the money being created. Your stock market has quintupled in a decade. By 1989, Japanese commercial land prices had risen 302% since 1985. A parking space in central Tokyo could cost more than a house in suburban London. Japanese buyers were purchasing Rockefeller Center in New York, Pebble Beach Golf Course in California, and entire city blocks in Los Angeles. Japan believed, genuinely, institutionally, that it had discovered a new model of capitalism, one where asset prices only went up. There is a specific name for when an entire financial system convinces itself that normal rules no longer apply. The crash was not an accident. What was a decision? In December 1939, a new governor took the helm at the Bank of Japan. His name was Yasushi Mieno. Mieno famously described the Japanese economy as dry wood, which could ignite at any moment. He viewed the asset inflation as a moral catastrophe, rewarding speculators while workers fell behind. Within days of taking office, Mieno began raising rates. The official discount rate went from 2.5% in May 1989 to 6% by August 1990. 5 hikes in 15 months. The dry wood caught fire immediately. Your land is so valuable that a single city block in Tokyo is worth more than entire districts of Manhattan. Japan had entered what economist Richard Koo would later call a balance sheet recession, where the private sector becomes obsessed with paying down debt regardless of interest rates. You can cut rates to zero, but it doesn't matter. Nobody is borrowing. The money multiplier collapses. It's what most people miss about Japan's trap. They look at the debt number, 263% of GDP, and they think, eventually, Japan grows its way out, or inflates its way out. There's always an exit, right? No, wrong. And the reason why is the mechanism. Ice 1. The zero interest rate trap. After Mieno's rate hikes detonated the bubble, the Bank of Japan spent the next several years cutting rates back down. By 1995, the rate was at 0.5%. By 1999, it hit zero. Japan became the first major economy in modern history to implement a zero interest rate policy, what economists call ZIRP. The logic was straightforward. If borrowing is free, surely someone will borrow. Surely investment will restart. Surely the economy will breathe again. It didn't. Nobody was borrowing regardless of the rate, because everyone was paying down debt. The Bank of Japan was pushing on a string. So in 2001, under Governor Masaru Hayami, Japan tried something even more radical: quantitative easing. The Imperial Palace grounds, a patch of manicured gardens at the center of Tokyo, are theoretically worth more than every piece of real estate in the state of California combined. Bank of Japan began buying government bonds directly. No major central bank had done this before, at scale. Japan was running the world's first real-time experiment in unconventional monetary policy. The patient didn't recover. The experiment continued. Fast forward to 2013. A new prime minister arrives with a mandate to break the deflation cycle once and for all. His name is Shinzo Abe. His economic program, quickly nicknamed Abenomics, has 3 arrows: massive fiscal stimulus, aggressive monetary easing, and structural reform. Ohiko Kuroda, Abe's chosen governor at the Bank of Japan, announces a program of quantitative and qualitative easing, so large it shocks even the economists who have spent years studying Japan. The BOJ would buy not just government bonds, but exchange-traded funds, corporate bonds, and eventually become a top 10 shareholder in half the companies listed on the Tokyo Stock Exchange. The third arrow, structural reform, largely disappears, because structural reform means telling powerful industries they need to get more competitive. That's politically brutal. The first 2 arrows are much easier to fire. Money, print, buy bonds, ounce, stimulus. Call it a plan. But here, the dark comedy of it all. The more the Bank of Japan bought bonds, the lower yields fell. The lower yields fell, the more the government could borrow without pain. The more it borrowed, the bigger the debt pile grew. The bigger the debt grew, the more dangerous it became to ever raise rates again. Economists fly in from Washington, from London, from Frankfurt to study you. You see the loop. The medicine created the disease it was supposed to cure. ICE 2, the yield curve control catastrophe. By 2016, conventional quantitative easing wasn't working either. The Bank of Japan owned so many bonds, it was running out of things to buy. 10-year Japanese government bond yields had gone negative, meaning investors were literally paying the Japanese government to hold their money. That is the financial equivalent of paying someone to store your furniture and having them burn it. Our Bank of Japan invented something new: yield curve control. In September 2016, under Governor Kuroda, the BOJ announced it would directly cap the 10-year government bond yield at 0%. Not manage it. Not cap it. By pin it. Enforce it by buying unlimited quantities of bonds whenever yields threatened to rise. This is where unconventional monetary policy becomes something closer to a centrally planned bond market. Hedge funds had been shorting Japanese government bonds since the early 2000s. Certain the math couldn't hold, and they kept losing. Niall Bass of Hayman Capital, David Einhorn of Greenlight Capital. Brilliant people. Wrong for a decade. But yield curve control had a side effect nobody fully anticipated. Books are written about your management philosophy. American politicians give speeches warning that if the United States doesn't adapt, Japan will own the next century. Because Japanese interest rates were pinned at 0, while the rest of the world began raising rates aggressively. In 2022, the interest rate differential between Japan and everywhere else became enormous. The Federal Reserve went from near 0 to 5.5%. The European Central Bank went from negative to 4%. Japan stayed at 0. This gap became the fuel for the largest carry trade in modern financial history. ICE 3, the carry trade monster. The yen carry trade. Borrow in Japan where money is almost free. Convert your yen into dollars or euros. Invest in higher yielding assets elsewhere. Pocket the difference. By 2022, with the rate differential at its widest in decades, the carry trade had grown to a size no one could precisely measure. Estimates range from $1 trillion to $4 trillion in outstanding positions. IMF called it a source of significant systemic risk. Quietly. Footnote: the way the IMF delivers news, it really doesn't want to deliver loudly. The carry trade works beautifully as long as the yen stays weak and Japanese rates stay low. The moment the Bank of Japan raises rates, yen carry trades start unwinding. Investors rush to close positions. They sell whatever assets they bought abroad, buy yen to repay loans, and the yen surges. Assets they reselling fall. Not fast. We got a preview in August 2024. The Bank of Japan raised rates by 0.25%, barely a rounding error by any normal standard.